Hello guys, so I received this question from one of the subscribers, and he was asking me, what if you receive Schedule K-1, right, and it has underlying 20Z, which is QBI deduction. It has lots of underlying investments listed. Do we need to enter each of them separately, or can we just aggregate them or summarize them and just enter the way it is? So this video will be a response to his question, and I hope that will be helpful for more than just one subscriber, of course, or even if it's one subscriber, I'm very happy. So if you have any other questions, feel free to comment below and I'll do my best to record the video in response to your question. Let's dive in. So this one is for qualified business income and deductions. And so sometimes we can receive the K-1 and it's really not listed on a face of K-1. So this information, we should look at the footnotes. So that's just a reminder to make sure to look at the footnotes of the K-1. And also on a face of K-1s, we'll have like an asterisk, or we'll have like a note that actually 20Z is filled up, but we need to look at the footnotes. So when we look at the footnotes, usually this is what we see. Sometimes we receive the K-1 and it's just kind of simple. We have one activity and it has like a couple numbers there, that it's usually an ordinary income, ordinary QBI income, W-2 wages, and adjusted basis. Those are like majority of the time, that's what we will see, and we'll see one activity. But what if we receive K-1 and on a footnotes we have like lots of different underlying activities? So it means that the partnership is invested in different other partnerships and they calculate QBI based on each activity, and I'm going to explain to you in this video more why they do it this way and why we do need to enter them separately for each underlying activity. So example of the K-1 you can see here. So we see, so this is one partnership and it has a footnotes that kind of like go over each underlying investments they have, and they calculate QBI for each of them, and they have each listed for them for each of them separately. So let's start with why, and do we need to enter them separately, or can we just calculate, sum them up and just enter as one amount? So in general, I would like to start with, like we do for all the boxes, let's look at the partner's instructions. So number one things under partner instruction, we can see which form this box, this line from K-1 should go on individual tax return. So for box 20Z, it shows us that it goes to form 8995 or form 8995A. And so those forms, as you probably know, those are QBI deduction calculations. So first of all, let's decide which form does it go to. Why there's two forms listed. So the difference is basically in their our taxpayers, taxable income. So if their taxable income is above thresholds, they have to fill up form 8995A. And also when they do that, they have to use the calculations that includes W-2 limitations and adjusted basis limitation, all that kind of stuff. Form 8995 is for taxpayers who are below certain threshold for taxable income. So they can use a simplified way of calculating QBI, right? So they don't really have to their W-2 calculations or an adjusted basis, like all that kind of stuff is not part of that adjustment. So, okay, so we figured that out, right? So now let me just go through IRS instructions for Schedule K-1 line 20Z and see what they say. So in general, we'll have a couple boxes listed on our 20Z. So that would be ordinary income. So that's qualified income they calculated for us, and doesn't include all the incomes the partnership receives. It excludes investment income, excludes guarantee payments, excludes a couple other things. So that would be just qualified business income from partnership, our part, right? Then we'll have another box listed for wages. So those wages are not going anywhere on Form 8995, but they do go on Form 8995A if the client cannot use simplified method of calculating QBI. And the same with an adjusted basis, right? So adjusted basis, it's just like fixed assets that the investment owns for more than 10 years, and that's just something they use, depreciated assets. So that's also part of Form 8995A calculations. So you would ask, like, do I have to enter it if my client doesn't make any money and it's below the threshold? So my answer would be yes, because if they are below the threshold this year, they might not be below the threshold next year. So I would recommend to enter all this kind of information so we have it carry over to the following years for calculate, correct QBI deduction. Another important questions you would ask is probably, do I have to enter each of these underlying partnership pass-through QBI information separately, or can I just, sum it up and enter as one amount? So the whole idea why they provided this information for us, because each qualified business income allowance is calculated separately for each activity. So for each underlying partnership, we need to calculate it separately, right? Or the software has to calculate it separately. We can aggregate those numbers, but it's just the special rules that IRS has for aggregation, and I'm going to go over them in a second. But in general, the simpler, the correct way is to enter each of them separately and let the tax software, or if you do it manually, good for you, calculate it separately for each underlying activity. And then it will, calculate the QBI deduction for that year. So even if your client is below the threshold for 8995A calculation, they might not be below the threshold the following years, right? So we want to make sure our carry forwards or disallowed loss for QBI deductions are correct for each underlying partnership that we own or the taxpayer own. So I'll show you, for now, I'm going to show you what is the aggregation rule, when can we aggregate. So I'm going to go over IRS rules, and then I'll show you in the tax software the difference between entering each underlying activity separately and entering it together. Let's dive in. Alrighty guys, so now I'm going to show you in Drake tax software what happens if we enter information aggregated or we enter information separately. Let's see. So to enter K-1 199A, box 20, box 20Z, which is 199A QBI information, we can go to a couple places. So one of the places is go to S Corp, and we go to box 20. We'll look for box 20 somewhere here. Where is the box 20? It's right here. So for S Corp it will be box 17. For K1s it will be box 20. And we just press here K1, K199. Another way to do it, we can just search for a proper place, and I actually like this one a little bit better, so I just press K199 and it just shows up like this, and this is just easier for me. So for now I entered that this is our ordinary loss from partnership, our wages, and QBI income. QBI, this is the basis limitation. And now when we go to our 8995A, it's and also let me start the way I'll show you how it all looks like. Might be a little bit confusing. So what I just did, I made the income higher, so the software fills up for me that form 8995A. But if I don't have, if my income is lower, for example, right here, it would just fill up form 8995, which is simplified method, and that's what it says, simplified computation. So I have this loss from prior year, it's 7,357. And if you're not sure where to enter it, let me show you. You just go to QBI, and it's kind of like takes you to that place. So I did enter that loss. So this is my prior year loss, and this is my current QBI. And the net of them is 10,343. And here it just calculates my deductions. So it's 2,069, right? So this is if it's below the threshold for form 8995A, and we can do simplified computation. So here we don't have anything related to W-2 income or the basis incomes that we need to enter, so much more simple. What if client has higher income and he needs to file that form 8995A? So if he does need to enter that, to qualifies for that, then his calculation will be completely different. So now his qualified business income, it's already netted that 17,000 we enter, and prior year loss carryover, and then it's kind of like limited to our W-2 limitations, and our there should be also a basis and QBI qualified business limitation. So it's already calculated it, and our QBI deduction is 2,069. So let me put it here. If we do aggregate it, this is what we have. But what if we enter it separately? So let's see. So we have 12,700, and we have 5,000, and for wages I believe this is what I used, and let's see, 10,000. And now, I'm sorry, I think I used 1,100 before, right? So it should be like 1,000 somewhere here, or here, for example. It really doesn't matter much. It just makes sure we have like a different amounts. So now when we go to the same form 8995A, it will do our calculations based on information we just entered, and we have a different amount, total qualified business income deduction, right? So, and how we can see it on our form 1040 is right here, 1984. So it would be just total for all of them. So I just wanted to show you that the amounts do change if you enter things separately, because it calculates it for each single QBI deduction. So my recommendation would be to enter it separately unless your client qualified for that aggregation rule, which majority of the times they don't aggregate, they don't qualify for that. Well, thank you so much. I'll see you in the next part of this video. As conclusion to, do we have to enter each underlying activity for QBI deduction separately from K-1 or not? The answer would be yes. We do need to enter them separately, so the tax software can calculate the correct QBI deduction for that year, and also we have a correct carry forwards to the following year. There is a simpler way to do it in a different tax softwares, and I hope AI would be here with us very soon to help us out with the data entry. So I don't think that it can be such a big problem. But for now, I personally sometimes manually enter each activity separately, because whatever I'm using is not reading through footnotes, and footnotes from each K1s are different, so that's kind of annoying, but I'm sure it's going to change up. But anyways, what we need to know as a taxpayer who provides the value, who want to make sure that tax return is calculated properly, so we do need to enter and keep track of each underlying activity of investment partnerships, because majority of K1s that have this kind of stuff are investment partnerships. So we do need to enter each QBI separately, track them separately, make sure we allow or disallow the losses for each underlying partnership separately, and then we combine it as well, but that would be a different story. So hope you find this helpful. Let's move on to the next item on the K1.